Hello, everyone. I'm Chad Smith, and I'm joined by my partner, Stephen Weitzel. And today we want to just review briefly the market environment in the U.S. So one of the traditional measures of the U.S. stock market is the S&P 500 index. We see that since the lows of the market back in October of last year, that index has been trending higher overall. But the interesting thing is the S&P 500 is unique in its construction. It's a market capitalization weighted index. So the question is, does it reflect the actual trend in the market in the US overall? Or is it masking something under the surface that we ought to evaluate more closely? So Stephen, that begs the question, what does the overall market environment look like right now? The market breadth itself specifically, is it healthy, or is it a bad breadth environment?
As we joke about it, the market does have bad breath right now. And that's typically something that we all want to shy away from or back up from. But the general idea here is that market breadth is all about participation. How many stocks are going up versus how many stocks are going down. And in order for markets to sustainably advance, we really need to see broader and more full participation. We can't just have a handful of stocks that are holding up the index. And so that's something that we talk about, in our monthly calls, where we're looking to be aligned with market trends, right? Our discipline wants to have us invested in areas that are going up and out of the areas that are going down. And so if we're going to be invested in areas that are going up, then we need to see beneath the surface. We need to have more of the constituents of those areas of the markets moving higher. So when we look at something like how many stocks are above their 200-day moving average, if a stock's above its 200-day moving average, it's probably in an uptrend. If it's beneath its 200-day moving average, it's probably in a downtrend. Well, right now, we see that well less than half of stocks currently on the New York Stock Exchange are trading above their 200-day moving average or in an uptrend. But even when we look at shorter term moving averages, 50-day, 100-day, 150, we don't see a single one of those moving averages that has more than half of the stocks trading above those levels. So it's kind of indicative of the fact that we see weakness broadly across the market on both the short end and even the intermediate to longer term views.
Yep.
So
yeah, it's definitely a reflection of a lack of overall health in the U.S. market. That's otherwise maybe masked by the S&P itself being up a bit more.
Yeah, and to your point earlier about the S&P being a market capitalization weighted index, so that means that the larger companies, they have more influence over the direction of the index. But when we look at the sectors that comprise the S&P 500, we see that only 3 of them are actually positive year to date, that most of them are actually down. But it's the big names that are in the technology, consumer discretionary, and communication sectors that are carrying the water for the market right now. And the question that's begged is, how long can that last, right? How long can the S&P 500 hang or hold up if more broadly most stocks are going down, right? So
if you look now at the equal weighted S&P 500, which is constructed differently, it's actually assigning an equal weight to every one of the 500 constituents. It's showing a different picture as of right now, isn't it?
I mean, definitely. I mean, this certainly is not an uptrend. This is turned off per our rules-based investment discipline, rolled over, where we saw earlier the cap-weighted S&P is still in an uptrend. So when we strip out that overweight to the biggest names, and we're giving an equal weight to every name in the index, we see that this is definitely not an uptrend, really maybe the onset of a downtrend. And we're kind of seeing the same type action when we look at mid caps. In our monthly calls, we've been talking about weakness in mid cap. A lot of the regional banks are in that index, so that's rolled over, currently turned off in our index. So not a whole lot of upward movement there. Same thing in small cap, right? So just really a reflection that the breadth in the market right now, it's not good. This is not the type of action that we want to see in a sustainable market uptrend.
Right, certainly.
And I guess, you and I were talking about this, right? We got this from some of our research folks, that the outperformance that we've seen from the cap weighted S&P 500 index is at some of the most extended ranges that we've seen it compared to the equal weight index. So let's talk about that a little bit.
Yeah, so what this reflects, this chart here, is these moments in time throughout history when the market advance has been more narrow, right? When this breadth measure is very narrow and shows a high concentration of only a handful of companies leading the charge. And it has coincided historically with some major interesting market turning points throughout history. A couple of those being actual market tops, significant market tops, like we saw at the very end of '99, the internet bubble.
Yep.
But then also interesting areas of the market, like in October of '02, which were really after that decline, market bottoms. And what happened there was the market was turning into a new, more sustained upcycle that was actually more broadly participated in, right? And so what we're looking for is a confirmation, or actually a resolution, of how this unique narrow market advance is going to ultimately be resolved in terms of indicating weakness under the surface that may lead to market decline, or actual catching up or kind of buying some time while the market broadens out and strength under the surface begins to appear and help sustain things better.
Yeah. And, so to that end, so here we are at really the same level where we've either seen big peaks or really good buying opportunities in the past. And we're not necessarily going to predict which one it is, because we never know. That's why we fall back to the investment discipline, right? To help us know if we need to be invested. But it kind of sets the stage for the fact that maybe this is a period where markets are peaking and there is more weakness in our future. But if not, it could turn out to be a really good opportunity to be in the market. Really, this most recent one in May of 2020, after we had the COVID crash, you started to have a little bit of a recovery in the market. This was not an easy time for people to be invested. Our rules-based investment discipline had us in, and it kept us invested in that market environment. And these were really good returns. These were really good times to be in the market. So who's to say how it plays out from here? But at least we have our investment discipline that will help us know if we need to be invested or not.
Certainly, yeah. Now, that being the case uniquely really within the US, it kind of segues into why we are overweighted or leaning toward international exposure at the time, because we're seeing a different environment or a little bit different characteristic outside of the US, aren't we?
Yeah, I mean, we definitely are. And it's been something we've been talking about for the last number of months, that there is weakness here in the US market. And so we don't want the fates of our portfolios to be so tethered to what's going on in the US market if, broadly speaking, they're not performing that well. We would much rather have more of the portfolios allocated to areas of the global equity market that are performing better. So when we look at international stocks, we see that a much more defined uptrend here with the large cap international stocks, but even with the small cap international stocks, where we saw both the mid cap and the small cap index here domestically that were rolled over and were down here, we're not seeing that at the small and mid cap levels on the international side. So really just a reiteration of the fact that if we're going to be invested in the market, we're probably better off to have more exposure overseas than we are here domestically. And I think that's probably where the better opportunities are.
Certainly, yeah. And that's what we're seeing in terms of confirmation within our rules-based investment discipline. So, with that, we reiterate that we're constantly being driven by our rules-based investment discipline guiding us to identify where these prevailing trends exist in the markets. And while we wait for some clarity to emerge in the US market, we're being patient, and we'll act accordingly as we see those confirmations come through. And, we're just wanting to today highlight that this market environment in the US, again, historically is very unique. It is associated with potentially some signs of reasons to be cautious, but yet patient is really one of the primary drivers for us at the moment, waiting for confirmation from our rules-based investment discipline to lead us. So
yeah,
with that, Stephen.
Thank you, Chad. Appreciate everybody watching. Obviously, if you have questions, feel free to reach out, call your financial advisor, or email us at info@reveillewealth.com, and we'll look forward to hearing from you. Thanks so much, everybody.